Let's focus now on oil. So U.S. crude stockpiles up just over 2 million barrels in the latest week. The street was looking for a drop of about 2.3 million. We are joined by Stephen Schork, principal at the Schork Report. Stephen, it's great to talk to you once again.
It's great to be back, Andrew. Thank you.
Anything for you in this fuel report or this oil inventories report? I guess the focus is distillates and gasoline right now.
Yeah, absolutely, Andrew. First and foremost, with crude oil, really, what we want to focus on is crude oil supplies in Cushing, Oklahoma, because this is the make and take point of delivery for the NYMEX contract. And last week, we saw a significant 1.6 million barrel decline in those inventories. Those inventories now are running at 50% below a year ago, and they are 9% below normal. Excuse me. So that, of course, is a concern. The other concern is gasoline. Gasoline, because we are now in the peak driving season. Gasoline demand picked up last week at the highest pace since the holidays last December. We are running, and I'm just looking at my notes here, we have about 24 days of forward cover of gasoline inventories. So this, again, is a year-to-date low. So we're looking at very low supplies. And to your point with distillate supplies in New York Harbor, again, the make-take delivery point of the NYMEX contract are at all-time lows. So we're looking at high demand, low supplies, and pretty much, Andrew, as we all know, that is the ingredient for even higher prices.
Tell us about, there appears to be a disconnect, though, between fuel prices and oil prices. Morgan Stanley said yesterday that gasoline and diesel were priced right now as though oil were $180. Can you explain how could there be such a big gap?
Yeah, I think they're looking at the wrong metrics or they're looking at the wrong analogs. If you're looking at history, yes, product prices relative to crude oil prices based on a historical perspective would seemingly be high, but we have to keep in mind the changing of the fundamentals. Since 2008, when oil prices hit a record high of $147 on the NYMEX, since then, distillation capacity in the East Coast, crude oil distillation capacity at refineries is down 56%. Processing capacity is down 64%. So our ability to turn crude oil into what we need, diesel fuel, gasoline, has been greatly diminished. So there is no longer that correlation. So it might seem, based on history, that product prices are overpriced relative to crude oil prices. Given that we have decimated the refinery industry here in the United States, no, product prices are not overpriced. I think they are fairly priced, and I think they are bound to go higher from this point on.
When you say decimated the refinery industry, I'm thinking about that Philadelphia refinery that caught fire a few years ago. Is that an example of capacity loss?
Yeah, that near and dear. That refinery is 15 miles down the road from our offices. Philadelphia used to be the refinery epicenter, the Houston of the East Coast. Our refinery capacity has been cut by 3/5 over the last 3 years alone. So once again, we no longer have the ability to make gasoline in our own backyard. So what does this mean? We have to go down to Houston, ship that oil up a pipeline. We have to put it on a barge in Houston on an American flag, which there aren't that many of, vessel to bring it into New York Harbor or Philadelphia. Or we have to go across the Atlantic to bring it in from the ARA refinery epicenter there. Those added transportation costs, that increased competition for global barrels just adds another layer of complexity, adds another cost driver to the price of gasoline here in the East Coast of the U.S.
Maybe we could put up a 10-year chart for Exxon Mobil, Stephen, because our Bloomberg partners are reporting that XOM on New York has just hit an intraday record high. Is it a great time to be a refiner and an oil producer right now?
Absolutely. This administration, every time it comes out with a new policy or Joe Biden opens his mouth, it just gives you another reason to go long oil. They have no plan to address the long-term structural imbalance between supply and demand. So if you are one of the lucky few that are still producing fossil fuels and selling it to the market, you are looking at a market where demand is only increasing. There is no policy to bring those prices lower. So yes, this is a fine time to be in the fossil fuel industry. And hooray for Exxon Mobil and all the other big oil companies that are making, quote unquote, these windfall profits, which of course is just an absolute joke because the industry average net profit margin is below the S&P 500 average. Exxon Mobil, yes, they're getting record earnings, but they're only earning about 6 cents on the dollar. That is by no means, Andrew, a windfall. So there certainly is room for the upside for the entire industry.
Stephen, we're seeing predictions, I'm sure you've seen them, that oil gets to potentially $150 later this year. Is that possible, do you think?
Absolutely. As I said before, 2008 July, the all-time record high on the New York Mercantile Exchange for WTI, $147.27. Right now, within the next 3 weeks, our modeling is based a probability of 14%. We take that record out, and we have a 24% probability we get there by the end of the summer, the U.S. holiday Labor Day in the first week of September. So the probabilities are certainly there. So we're looking at now oil prices trading comfortably at above $120 a barrel, Andrew. That translates into a national average, which right now is about $4.95. By the 4th of July, I expect to see gasoline prices national average $5.20, $5.30. If we get to that $150 range, now we're looking at a gasoline price at the pump of over $6 a gallon, which just concretizes, Andrew, the fact that the United States, if we are not in recession now, we will be in recession by the fourth quarter because, quite frankly, Americans or no one can afford to pay what we're currently paying at the pump or the grocery counter. So every single recession, Andrew, since 1974 in the United States, 6 in total, have been preceded by massive rises in energy and food costs. The current rise in those two costs we are seeing now, we've never seen before. So it's not a question of if the United States is going to recession. The only question is when we go into recession. And I venture sooner, i.e. after the summer, rather than later, early next year.
Very quickly, Stephen, I'm sorry, we've only got about 15 seconds, but if America goes into recession, presumably that helps to bring oil prices down.
Yeah, absolutely. So that's the great news. Oil prices, people, are coming down. The bad news is it's coming down because we're headed for a severe economic downturn.